I'm going to show you what the 4 tax buckets are and why using them for tax planning could help you lower your tax burden in retirement and pay the least amount of taxes that you're legally obligated to pay throughout your entire retirement. So go ahead and watch the clip of the webinar that I did on taxes in retirement. Enjoy.
Also, like I said, you want a kicking high amount of money to you and none to Uncle Sam, right? That's another issue that we have, competing financial needs. And so to understand how to lower that tax burden, we really need to understand how our money is taxed. And first off, there are 4 tax buckets I think really do a good job of this. The first bucket, what we call the after tax bucket. What does after tax mean? That means you contributed to it with after tax dollars. You did not get a deduction to put money into there. And that would be if you put money just into a CD, if you have money in a bank account earning point nothing, that little point nothing, that is an after tax. You're taxed on that every year. If you have money in a brokerage account that's not an IRA, it's not a Roth or anything like that, it's just what they call a non-qualified account or a joint with right of survivorship. It's one of those, right? It's a brokerage account. That would be an after-tax account because you didn't get a deduction for it to go in there. You paid for it with money that you were already taxed on, right? Before you saw it, you got it, taken out of your paychecks, and then you contributed to that. The way that you know whether or not you have an account that is after tax is if you get that love letter from the IRS every single year, even if you didn't pull any money out. That love letter is called the 1099. And the 1099 INT for interest, 1099 DIV, whatever for dividends. If you get that every single year, even if you didn't touch the money, that's how you know you have one of those accounts. Well, then we move to the right a little bit and we find out, well, we've got a tax deferred bucket. Well, what's that? That bucket is going to be what we're all mostly familiar with, right? If we're contributing to a 401k at work or maybe a 403b, or there was that question about Capers. Capers has a 457 savings plan, and they're all interchangeable. They're basically the savings plan for that particular company or that particular municipality or government, right? And so they all get a tax deduction when you put the money in. It grows tax deferred. You don't pay any money on that growth until you decide to pull that money out, and you're only going to be taxed on it when you pull the money out. Now, here was the thought process behind this. And if anybody has a different thought process or a different opinion, or you were told something different when you were started investing in this, raise your hand, let me know. But it was told to us like this, right? Get a deduction now because you're working and you're making a higher income. When you retire, you're going to not be working, so you'll be making a lower amount of income and you'll be in a lower tax bracket. So when you pull the money out, you will be taxed less. That's what they told us. Here's the problem. A lot of my clients are not in a lower tax bracket when they retire. They are in the same tax bracket or even a higher tax bracket because now all their Social Security, they're making enough money through Social Security or maybe a pension, or they did a really good job of saving. And so now they're actually paying more. Another reason is, where did all your deductions go? Well, they grew up and left, right? At least I hope so, right? That's the whole idea of raising the kid, is eventually you want them to get out. And so now all of your deductions are gone. And so in a time when we thought we were going to be in a lower tax bracket, we're not, but we were told we were. That's how they sold it to us. I have a podcast called Retirement Rescue Radio, and one of my episodes, I cannot remember the number offhand, I'm sorry. One of the episodes is called the 401k scam. And I actually go through the math for the majority of the people. This is not going to be everybody, but for the majority of the people, on how much money they are actually saving in taxes during their working years versus how much they are actually going to spend in taxes once that account balance has grown. And it ends up being about 3 to 4 times the amount of tax that you are going to spend in retirement versus what you saved while you're working. And so I don't say that to tick everybody off. What I say is, now, since that didn't work like we were told it was supposed to work, well, now it's time to come up with some type of an exit plan without having to pay way too much unnecessary tax in order to do that, right? So that's what we need to do. So now let's scoot over a little bit farther to the right here. We're going to go to the tax-free bucket. What is the tax-free bucket? Well, that's going to be your Roth IRAs. You don't get a deduction when you put it in there, but all the growth is tax deferred and tax free. And when you pull money out, it's also tax free. So that would be that. There's also cash value life insurance that you can do that with as well. If you pull it out the correct way, that can also be tax free. And like I mentioned, it does not increase the amount of tax you pay on Social Security. Also, a lot of life insurance proceeds, like if someone passes away and leaves you a death benefit, that is usually tax-free as well. Tax-free trusts means now not only is it income tax-free, it is also estate tax-free. A lot of people don't realize that Roth IRA money is estate taxable, which means if you have over the estate tax limits and part of the money that goes over those limits is Roth IRA money, you will pay estate tax on that. Or excuse me, you're gone, right? So your estate will pay taxes on that. So then you have to start talking about like irrevocable life insurance trusts and stuff to get out of your estate. But yeah, with the estate tax limits so high now, we really don't see that, at least in the Midwest. We don't see that a ton. We'll see it, we just don't see it a ton. Oh, and if you want to lower your taxes over time, got to move your assets to the right. And when I say over time, it's because of this. Let me scoot up here a little bit, back here. Over time, so I mentioned early on that I actually used to prepare taxes, and if you're sitting there and you use a CPA, I'll lump myself in with that, because when I used to do taxes, they could do taxes with me, they could do tax with a CPA, it didn't matter. We are your hero if we do what? If we get you the biggest refund, or we lower your tax liability to maybe to where you don't owe anything, right? We're your hero if we do that for you in that year. Forget about the rest of the years, right? I mean, I mentioned this bucket right here, right? Pay way too much tax on the growth of all that after it has grown than what we actually saved, right? And so we're told to get the lowest amount today. Well, what we want to do is, instead of taking a micro look at taxes, we want to take a macro look at taxes now when we do tax planning for retirement. We want you to pay the least amount of tax that you're legally obligated to pay over time. Over time. Not just this year, because saving this year might actually cause you to pay far more next year, or not next year, but like even down the road. So we want to do it over time. We want to take a step back and look at your entire, basically your tax life, and find out what's going to happen there. And so to do that, we've actually worked with actuarial and CPA firms to develop software that actually can show that to you. And not only that, can actually compare one strategy versus another strategy. What's the lifetime impact of the taxes?
Now, wasn't that some great information? A lot of our clients are definitely grateful to us for helping them lower the taxes throughout retirement. And if you would like someone on your side to help you navigate the future tax map through retirement, you can simply schedule a conversation with us by clicking the Calendly link in the description. Or if you would like to see how much tax savings you could benefit from in retirement, then you can just check out the next clip of this webinar by clicking on the video right here. Are you like Alan? We don't know. And if you want up-to-date content, just make sure to smash that subscribe button, hit the notification bell. That way you'll be updated every time that we post new content, because we want to give people the confidence that their retirement strategies are going to give them income to last as long as they do, so that they can enjoy the retirement that they deserve. So once again, smash the subscribe button, hit that notification bell. We'll see you on the other side. Take care.